Hey everybody, welcome to our alternative investment education event. I'm here with Chad Payne, Mr. Extraordinary Alternative Investment Man. He's going to teach us all about alternatives today. We're going to go over a couple of upcoming events. So on Thursday, November 18th at 5:45 in person at the Macon office, we're going to have a little lunch and learn, dinner and learn at 5:45, all about tax planning. So sign up for that. We're going to send out the invite for that next week. We're going to sending out this to everybody to save the date for our Hawaiian luau. Luau, not a luau, a luau. This is for client referrals. So if you refer a client, refer a friend, and they become a client, you can get in on this. So we're excited to have this. This will be January 8th, 2022, and that's going to be at the Fall Line Station here in Macon, Georgia. And it's going to be tons of fun. And so without further ado, I'm going to turn the time over to Mr. Chad. And I'm going to be manning the chat box, so put your questions in there, and I'll stop Chad if it's something he needs to answer.
That's right. Thanks, Shana. We're going to be focusing on alternative investments today. We're going to be focusing on structured notes, or we also refer to those as bank investment notes. Some of you folks tuning in may already have those in your portfolio, but we'll dive a little deeper into them today. And if at the end, again, we'll take some questions, maybe even along the way, but hope to answer your questions and introduce you to possibly a new investment strategy that you might be interested in. So let's get started here. Okay. So there, again, bank notes or structured products, structured notes. We'll kind of refer to those one and the same throughout the day here, but we got some of our fun disclosures to go through here. As you know, we can't make any promises or guarantees, and there's certainly risks involved with these, even though, and I'll go over those in just a minute, even though they are offered by banks, there are some risks involved with these. So. Okay, so as we know in our economic landscape right now, there are some challenges in throughout the investment landscape. Or here on the left here, we see stocks are at all-time highs or near all-time highs. In fact, this week we've hit some new all-time highs once again. So that's great, but on the flip side, how much higher can they go and how much longer can that last, right? That's the question on everybody's mind. Then the global economy, it continues to improve, but it is improving at a slower rate than it was. So then the flip side of that question is global uncertainty also remains extremely high. There's a lot of things going on, geopolitical factors and other things that are, again, getting us a little worried in a lot of areas. Couple all of that with fixed income yields, while the U.S. remains attractive compared to rates globally, we're in an incredibly low yield and interest rate environment. And bond prices are likely to face new rate increase pressures as yields rise. Then the prices of current bonds go down and lose value. So, and we all know that bank CD rates and interest rates through banks are super low. People have talked to us all the time about that, getting renewal rates of 0.5% and even lower on money maybe they had locked up at much higher rates earlier. So today we're going to talk about some things that addresses a lot of those questions we just asked there. They're going to be, again, structured products, and we're going to go over what are structured products, the potential benefits of those, and are they right for you? Because again, this does have risk involved and not suitable for every single person. So what are structured products? Well, first of all, they're debt obligations, and they're issued by large global banks. So we've used banks, Barclays, we've used Bank of America, Societe Generale, some of the ones that we've used ourselves. There are many others that issue these as well, but they aren't your local down the street branch that offer these. These are large global banks. So the financial backing of those is strong and solid. Certainly we want to use a bank that has good financial footing. They're also known as market linked securities, or as I mentioned, bank investment notes. It's kind of a layman's term for it as well. But basically, they link one security to the performance of another asset by using options. And you sort of see the option and traditional security grid on the other side. I'll get to in a second, but there's flexibility to be designed to almost any investor need. We have notes that generate income. We have growth notes. And then in some cases, we even have principal protected notes as well. So most of these, however, are not FDIC insured. The principal protected notes will be, since again, they're offered by banks. If they offer the principal protection, it has the FDIC backing on it. But they are complex financial instruments that involve significant risks and are not suitable for everyone. Typically, our broker-dealer restricts us to only investing 20% of someone's net worth into these types of products. So, and that's for everybody's protection, for your own good. You don't want to get everything in one basket, as we know. Oh, let me go back to that real quick. So on the block on the side, so options are typically used. They're going to be that's what generates the income or the growth component of these. And then the traditional security that's underlying there tends to be, think of it as a zero coupon bond, where we take a portion of the funds that are invested and we have a future maturity date, and but the interest rate that zero coupon bond pays grows our original investment back to the original principal we put in. So that's what supports the underlying guarantees and the maturity dates that allow you to get your money back upon maturity. So those are the two components. The options give it the interest rate ability to grow or pay the interest rate in our growth model there. Okay, so just big graph here. There's a lot of people have not heard of these structured products, but they have gained more mainstream use in the last 10 plus years. Institutional investors have used them for years to hedge risk and to still have growth potential. The U.S. markets rapidly grew in the mid to late 2000s, and now many are available to investors. The ones that we use, typically you can purchase in $1,000 increments. So that allows a lot of people to access these. Typically we like to do 5,000 or greater, but we can access even 1,000. So they are not quite as liquid as many traditional securities. They do offer a mark-to-market daily value. That would basically be what you could sell it for on that given day, but they are designed to be held to maturity or until they're called. We have experienced, though, when we have a situation, an emergency, we need to sell some of these. We have had pretty good luck with getting those sold and having the liquidity that we need in there, but there is no guarantee of that. So the grid here shows the current global outstanding volume. It's been very stable since 2012 is what this is showing. Typically between 1.6 to 1.8 trillion dollars of these items are outstanding globally. So that is a pretty large market when you think about it in the trillions there. So here's some questions and things you can ask yourself. If this is you, then these structured products might be a good fit for some of your money. So if I want to invest in the stock market, but I'm worried that it might fall. We hear this all the time, especially when things are nearing all-time highs. You're going, how much more can we grow here? So something to consider is a growth-oriented structured product that seeks stock market participation with limited downside protection, like a buffered structured note. We're going to go over the details of that in just a minute. But again, it offers upside potential with downside protection. Not 100% downside protection, but a limited amount of downside protection. So if I want potentially attractive levels of investment income, who wouldn't like that? We like to to get nice interest payments, but we can't get those from our CDs right now. If we hold bonds, they're very low as well. But we could use a yield-oriented structured product designed for ongoing periodic payouts, such as an income structured note. This is probably the majority of notes that we have in our clients' portfolios. They pay a interest rate it's an annual rate. Generally, they pay it out quarterly. We have some that pay out monthly, but that's nice to see, those consistent payments as long as they meet the parameters of the bank note. Then finally, if I want higher potential returns than CDs, but with FDIC insurance, again, I mentioned some of these do have FDIC insurance. A market-linked CD, instead of a note, it would be considered a CD. It combines principal protection with a degree of stock market upside. So we get each of these types of investment opportunities. We get a sort of an inventory of these, if you will, each month. And each month, the note offerings vary, and they're based on stock market volatility. That helps the price of the options, that changes. And then also the interest rate environment. All are variables as to what those look like. So each and every month, these banks sort of reprice based on all those parameters, and then we get what those offerings look like. Sometimes we get better interest rates than others. Okay, so now we're going to go over a few of these that I just mentioned here. I'm going to show you some little detailed examples, kind of high-level view still, but show you exactly how each one of these work. So this is the growth note that I'm going to go over here real quick. It's got stock market participation with limited downside protection. So both of those sound really good, right? Some of the risk of the market, but also participating in some of the growth. So this one is considered a buffered note, and these are just sample terms. We have, terms could be better or worse or slight variation of this, but it's a 5-year maturity. And it's going to be pretty much held for that 5 years would be the ideal situation, as I mentioned. The underlying index that it's tracking is the S&P 500. So over on the right-hand side, it has a downside protection buffer of 20%. So think about that. If the market goes down 20%, you've actually lost nothing. It's going to buffer you from that loss up to 20%. And then on the flip side, the upside potential, there are two factors in this one. It's 120% participation rate. So if the market's up 10%, for example, you're actually going to get 120% of that, which would be 12%. But there's a cap on how much you can make, and that's 50% for the life of the 5-year term. So technically 10% a year in this scenario. So several moving parts there, but hopefully I explained those well so that you've got that upside participation up to a cap, and then downside protection with this 20% buffer. So let's look at the scenarios that you might encounter during this maturity period for the 5 years. If the index rises, the underlying performance there, I've already mentioned a couple of these. If the S&P is up 10%, you get 12% because you get 120% of the participation rate of what it's up. The middle scenario there, S&P is up 25%, then if 120% of that is a 30% return, so even better than the actual index did. The other scenario, if the index is up 60%, you're still getting 120% of that, but you're capped out. You're going to cap out at the 50%. So all three of those are very good scenarios. If it's basically under a 50% return during that 5 years, you're going to probably cap out at 120%. If it's on the upper end. So, but if it's over the cap, then you're not going to get any more than 50%. Okay, so those are all three good scenarios. Middle scenario there, index is flat. So if the S&P 500 is up 0% from the day you bought it to the maturity date 5 years in the future, you just get your principal back. You didn't lose anything. You didn't gain anything. So that's one scenario. We typically know markets will move over a 5-year period, so we hope to not encounter that on a flat index. But let's look at if indexes decline. Certainly we know that that's the case. That can happen. In history, typically a 5-year full decline is hard to see. Usually when we have a decline, it does come back, 18, 24 months, somewhere in there. So, but here's where your protection comes in. S&P is down up to 20%. On maturity, you get 100% of your principal back as long as you don't go over that 20% buffer. So in a scenario, the worst case scenario here, if it's down more than 25%, or excuse me, more than 20%, you lose 1% of principal for every 1% the index is down more than 20%. So in this example, if the index is down 30%, you lose 10%. The first 20% of loss was protected. So, and then you get 90% of your principal back in that scenario. So each one of those, that's another nice thing about it. There's a defined outcome. We know kind of what the outcomes could be. Obviously, one of those is not positive, but the others certainly are. You either get your money back and suffer no loss in a lot of those scenarios, or make money, even make more money than the market actually returned in some cases. Okay. This is probably the most used one that we have, as I mentioned a minute ago. This is an income note. So our goal is to achieve higher income than current fixed income rates, because as we know, bond rates and again, CD rates are super low right now. So this has a couple of more moving parts and slightly different definitions here, but it's still very effective. So this is called a contingent coupon callable yield note. So what does that mean? We have a coupon that is paid contingent upon meeting a couple of one variable. As long as we don't break a barrier, we're going to get that coupon payment. It's callable in the fact that it can be called. Some of these are after a year. Some of these are as short as 6 months. If they're ever called, they give you all of your principal back and any interest that you've earned up until that point. And then you just go about your business and decide, do I want to do this again, or do I want to do something different with my investments? So this particular one has a 3-year maturity. So that's the maximum length. It's callable annually. So after 1 year, it could be called. Typically, if the underlying indexes are at or above where we started, then it would be automatically called on that first anniversary. And then it could be called, most of them are every 3 months thereafter. So in a rising market, you typically won't have these go to full maturity. They'll probably get called early. So this one has underlying indexes of the S&P 500 and Russell 2000. So we've got 2 big indexes we're following there, and it's always going to be the lesser of is what they're going to measure to see what parameters we're fitting into. So over on the right-hand side, we have downside protection. So 70% principal barrier at maturity. Think of it as we can lose up to 30%. That's the flip side of the 70% barrier or minus 30% protection. And because it's a barrier, anything in between 0 and minus 30% is protected. When we cross that 30% threshold, that's when we'll have some risk. I'll show you in a minute how that works. And then, so that's at maturity. We have that minus 30% downside protection. And then on each quarter, we're going to be viewing to see if we qualify for the coupon of 6% annually, but it gets paid each quarter. So it has the same parameters quarterly. It has a 70% coupon barrier, or think of it as a minus 30%. So as long as those indexes don't go down more than 30% from start to the end of the first quarter, you get paid a quarter's worth of that 6%. So here, again, we'll look at these scenarios below in the grid, because obviously there's multiple scenarios here. You can win or you could, potentially lose. So in this scenario, neither index falls more than 30% from the issue date level. So you would receive 1.5% coupon payments each quarter that would total to 6% on an annual basis. At least one index in the second scenario, at least one index declines more than 30% from the issue date. Those quarterly payouts, you would actually get skipped. If it broke the barrier on one of your quarterly observation dates, you would not get the coupon payment that month. However, there's no harm to your principal as of that point. You just missed out. So all of a sudden your 6% annual might become, somewhat less because you missed a coupon payment.
Hey, Chad, we had a question.
Okay.
Okay. In example 1, it says, does the S&P have to grow at least 10% before any return? Would you gain anything with a 1% to a 9%?
Yes, you would. You would gain whatever percent it does grow by. You would, they would multiply that by 120%, and that would be your gain. So yeah, they just sort of use round figures for these examples. But if you cut that in half, if you grew 5% and 120% of that would be 7.5, I think, rough math there. So yeah, you would still get growth potential even as long as it's positive at all. Okay, so sorry about that, but hopefully that answered that question. We'll go back to, now we'll look at the principal scenarios for this income note. And again, this one gets a little, there's a few more moving parts than that first one I described, but so there's several scenarios that we could have play out here though. The security could be called before maturity. And if that happens, as I mentioned, you get 100% of your principal back plus any interest that you've earned up until that point. And that will happen on these auto call notes if the index levels are at or above where we started once we reach those call provision dates. So the middle scenario there, neither index has fallen more than 30% from issue date at maturity. So at that time, we get 100% of our principal back, and we've earned any and all coupon payments that we have earned throughout the period. So this one was held for 3 years. Nothing broke the barrier. We get all our money back. So the final one is the negative scenario. At least one index declines more than 30% from issue date level at maturity. So we get all the way on that final day of maturity, 3 years out, the S&P 500 is greater than 30% down from where we started. And that certainly could happen. Historically, looking back in 5-year increments, it hasn't happened very often. But for this example, it says principal declines proportionally. If you're down 40% from where you started, then your loss is actually 40% of your principal. So that is not a good outcome for sure, but that means the market is down at least that 40% too, or whatever index this is tracking. So out of these scenarios, 1 out of 3 is negative, 2 out of 3 is positive. So that, again, that's where the risk certainly comes into play. But still, we have some defined outcomes. We know exactly what we're going to get if we meet these parameters. Okay, and finally, the principal protection note. So it has stock market upside with principal protection. This is one of the CD versions, not a note version. It does have the FDIC insurance. So it has it's a market-linked CD with principal protection. It's a 5-year maturity against the S&P 500. So you're going to see with these CDs, they're not going to have, thank you, Shannon, they're not going to have as much upside potential because they do have that FDIC protection. So this one only has upside potential. It's got a 100% participation rate with a 20% cap. So, and that's over a course of a 5-year period. So it technically would be like 4% a year is the average cap. But it could grow up to 20% over 5 years. But it offers principal protection. You're guaranteed to get your money back at maturity, worst case scenario. So this one has all basically good outcomes. You really can't lose any money. If the index rises up to 10%, again, they just use some round figures, you would get 10% of that. They would cash you in pretty basically at maturity, and you would get that 10% return. If the market is up 30% during that same period, you would cap out and you would only get the 20% return there. If the index is flat and didn't earn anything, you get your money back at maturity. If the index is down, and it doesn't even matter how much, you still get your money back at that point, principal guaranteed and FDIC insured. So that is a very attractive one. With interest rates being as low as they are, these haven't been quite as attractive. You've got to go out a little far on the ones we've had in inventory lately to get reasonable rates of return. Again, that principal protection is nice, but you also want to try to earn something in between. So, we keep an eye on these, but we haven't used the CDs nearly as much as we have the notes, just for those reasons right there with low interest rate environment. Okay, so that kind of gives you 3 scenarios, and I know that was a lot of information and kind of quick, and they do sound a little complicated, but we can certainly help you understand them. And again, we can only put a portion of your assets in these for various reasons, as we talked about liquidity, the complexity of them as well. But in reality, these are some misconceptions that we see people when we explain these to people. It says, it sounds too good to be true. I can get some upside potential also with some protection. Well, the reality is they're highly customizable. We have some that have really high interest rates of those income notes that we talked about. That usually means there's more risk associated with them. We have some that have lower interest rates because they do spread the risk maybe with larger indexes or for longer periods of time. But each month we have customizable options to give the exposure you're looking for. Also, liquidity and issuer credit risk, and fees are all key considerations. So that, again, it's not everything's guaranteed, and you need to look at the bank, the issuer, and make sure that they're credit worthy, and also that that there are risks involved there. So they're too complicated. This is a quick view of it, and you might be thinking that right now, but understand what you're buying and how it is likely to perform in different market scenarios. Hopefully that gave you a good picture of what those might look like. And then also it helps to define a better outcome within a portfolio. So that typically they can be blended with other investments that you have to diversify and just help you have a better outcome. And this is one of very few things where I can tell you what the future is going to look like. It's going to look like one of 2 or 3 scenarios like we just laid out here. I can't tell you that with a stock or with a mutual fund or anything like that. Too illiquid. That's certainly a question people have. And again, that's one reason we don't put more money in there than the 20%. But benefits realized when held to maturity, selling prior may result in a loss. Again, that would be the idea, is to hold it to maturity or until it was called and not try to cash it in early. So we want to make sure you have plenty of adequate liquidity in other areas if you need it. It is meant to be as part of a broader portfolio, not the only thing you invest in. And each bank may make a market for their own outstanding offerings, though it's not required. That's how you actually can redeem the shares or redeem the notes, and we can even redeem them in $1,000 increments too. If you absolutely had to have some liquidity, was just more than likely we'll get back less than what you bought it for. Have to take a discount there. And then too risky. As with any investment, you got to carefully weigh risk exposure versus potential benefits. And generally, these are offered by prospectus and includes detailed information about terms and other key considerations. Those prospectuses usually will show you those scenarios we laid out here. Here's your good scenario, your middle of the road scenario, and here's your worst scenario. Okay. So finally, some general characteristics that we went over here, just to recap this. The potential benefits, they offer customized risk reward profiles to meet a wide range of potential goals. Again, we get a inventory each month, and we can kind of tailor something. If you're looking for something very aggressive, we can find it for you. If you're looking for something very conservative, we usually have those as well. And the more conservative they are, generally the more matrix pricing. The banks provide a continuous bid offer, so your statement will actually show a daily value. If you buy 10,000 units of one of these, then each day it's going to trade or show a daily value. It's probably going to be less than 10,000 until you get closer to your maturity date. But that's sort of, again, just keep in mind that's when, if I needed to cash it in, this is approximately what I would get if I cashed it in. If I hold it to maturity, the likelihood of me getting back my original $10,000 investment is really high based on the parameters of the note. So liquidity, it's not actively traded, but generally held to maturity or when called. The banks may make that market in their own offering and be able to buy those back, at a price there for you. So the main risks, liquidity, again, we've hit on that pretty hard. And then issuer credit risk. So the ability for that bank to meet its obligations. The underlier returns are outside the protections or the upside cap. So that's another risk. If you get outside the protection area, then you can lose principal or miss out on coupon payments. And if the market goes up higher than the caps, then obviously you're going to get capped out. That's not the worst case scenario, but you didn't make as much as maybe the market did. So dividends, there generally are no dividends. Any income notes, they provide a coupon payment based on the parameters of how it's built. We talked about that 6% example earlier. So there's no actual dividends like a stock would pay. And then tax treatment. Gains can be taxed as ordinary income. In most cases, the income notes are ordinary income. The growth notes are going to be capital gains tax, typically long-term capital gains or original issue discount, and depending on each offering, and it tells you how they're set up in the prospectus. And you can consult with your tax advisor if you have any doubts on that. Usually the income is taxed at your normal income tax rates. Capital gains could be lower than that unless we change those in the near future. But both of those can be beneficial to you. You just have to understand that it is taxable unless it's inside an IRA. Okay. So finally, are structured notes right for you? And these are questions to ask yourself. Are you looking to better control equity outcomes or increase investment income or CD return potential? So if that's the case, we probably have a note that we can, if any of those fit you, that we can find for you. Do you have a market view or financial goal that is better supported by a structured note compared to a long-only investment? In other words, we can tell you what these outcomes will look like. I can't tell you what the stock market's going to be like if we're only invested in long stocks, buying, whether buying, hold, or trying to trade. But these notes, we can tell you what the outcomes will be within a few scenarios at least. Are you able to hold the security to maturity in order to achieve its full benefits? That's certainly important. If you need liquidity sooner than the maturity date, then these probably are not right for you. Are you comfortable assuming the credit risk of the structured products issuer? So again, that's where the bank that's involved. We typically can't put more than 10% in any one note. So we do kind of try to spread out that credit risk from issuers as well. So all of those are key things to consider when you're investing. But again, if you answer yes to some of those questions, these might be for you. So finally, the key takeaways: it links one security to the performance of another asset using options. This flexible design helps better define an investment outcome potential. We can give you those scenarios that are laid out at maturity. It helps broaden traditional diversification by providing a degree of downside protection and/or enhanced return potential. And as with any investment, carefully weigh the potential benefits versus the fees and the risk exposure. So all of those things are certainly taken into consideration when you're looking at investing really in anything. Okay, well, thank you so much for your time there.
Breaking up a little bit. There you are.
But certainly myself. There you go. Certainly myself or Shana or Daniel could certainly help you with these if you have any more questions about them. Again, we get the new inventory usually at the beginning of each month, and they price and they purchase toward the end of the month. So some of you guys, as I said, that are tuning in even have those or have had these in the past. So if you have any questions, just give us a call. We look forward to serving you going forward here. And anytime you need us, don't hesitate to call. Thanks.
See you guys.